Thank you so much for joining. The last video on ratios, we did one on profitability, one video on activity ratios, talked about solvency ratios, and now liquidity ratios. And liquidity ratios is similar to solvency, but focuses on short-term obligations, where with solvency ratios, we looked at how much debt does the company have, what are the long-term obligations that arise due to debt. We talk about risk and financial leverage. When we look at liquidity ratios, it's more about whether a company is able to meet its short-term obligations. Liquidity ratios usually reflect the company's position at a point in time. That's why here, although we are using balance sheet items, we are not using any averages. We just use ending balance sheet items rather than averages. Yeah, I think all of those, except the cash conversion cycle, all of those, they just focus on the balance sheet and compare what type of assets and liabilities are available or occur at a certain point of time. So let's get started. Current ratio. Current ratio, first one, current assets, current liabilities from the balance sheet. The higher the number, the higher the level of liquidities, because current liabilities, these are the obligations that the company has. For example, accounts payable, has to pay suppliers, other shorter term liabilities, other payment obligation that may come due. And the assets are basically the means the company has available to use. We use current assets. It's a broad figure, includes cash, marketable securities, receivables, also includes inventories, because if we have obligations, some current liabilities that we need to settle, then we can convert our current assets into cash and pay for our obligations. And the more current assets we have, the more is available to be exchanged to cash and then to pay our obligations. However, there is value loss. You can't directly convert your inventory into cash right now. First, it takes time, and second, there may be some value loss. That's why we have some additional ratios, but in general, the starting point is current assets, current liabilities. A lower ratio indicates less liquidity, implying a greater reliance on operating cash flow and outside financing to meet those obligations. Quick ratio, again, same concept, but is a more conservative ratio because it includes more liquid current assets. Here, inventories that are less liquid compared with receivables, short-term marketable securities, and cash are excluded. So it really looks at, okay, what type of current liabilities, current obligations do we have, and what kind of very liquid assets do we have that we can exchange for cash. Yeah, so the quick ratio will always be lower than the current ratio because the denominator has not changed, but the numerator has decreased because we have taken out excluded inventories compared to current ratio. Then the last one is even more conservative, cash ratio. Here we even exclude receivables and inventory. So here we only look at the most liquid assets. Cash is already converted into cash. Short-term marketable securities are assumed to be very fast to be converted into cash, which we can use again to pay our current liabilities. There's another one, so these three are more common. There's another one called defense interval ratio. In the startup scene, we call it burn rate, which is basically how long a company can pay its daily cash expenditures using only its existing liquid assets without additional cash flow coming in. So if you assume you don't sell a product, you don't have customers yet, you have some shorter term assets available that you need to use, especially here your bank account cash, how much cash expenditures, things that you actually need to pay in cash, do you have on a daily basis, and how many days do you last. The more cash you have, the more current assets you have, the longer you last. Same here, the daily cash expenditure, the lower this number, the longer you last. So a high number means here, if we look at defensive interval ratio, a high number means you have more available and you last a bit longer. Yeah. So if you have a defensive interval ratio, let's say 50, that would mean that the company can continue to pay its operating expenses for 50 days before running out of money. Yeah. Good. And then cash conversion cycle is one as well, which I discussed more in activity ratios, which is DOH, DSO, DPO, or sometimes DIO plus DSO minus DPO. Days sales outstanding, days payables outstanding, and days inventory outstanding. Inventory, current asset, current liability perspective. So you see the connection with your working capital. Current assets minus current liabilities. We exclude cash here for this illustration. And then we have inventory plus, not CA. Inventory, accounts receivables, and accounts payables. And then we have inventory plus accounts receivables minus accounts payables. And then here, difference is working capital is a number, a dollar figure, whereas your cash conversion cycle is measured in days. Yeah, how many days it takes to convert cash, to collect payments from your customers, or to pay your suppliers. Yeah, which gives you an indication again about the time that elapses from the point when a company invests in its working capital until the point at which the company collects cash, which is the cash conversion cycle. Yeah, these are the key liquidity ratios. Again, really focused on short-term obligations and the assets available. Thank you so much for listening. I hope you found this useful. See you in another video. Bye-bye.